The Broker Roundtable is meant to provide some insight from the guys and gals in the trenches fighting out the deals, my fellow brokers. This quarter, the board has decided to conduct this in an open format as opposed to individual presentations in hopes to kind of spark some insightful dialogue and just change it up a little bit. So at this time, I'd like to invite the participants up to the stage. Aaron the Priest, Brandon Rogers, Ian Stewart, and Gary Heinfeld, please come on up. Aaron the Priest joined Cushman Wakefield Picor in March 2012. As a native Tucsonan, his community ties and retail market knowledge make him a standout in the commercial retail arena. Aaron brings depth to Cushman Wakefield Picor's seasoned Tucson retail brokerage team, where he represents both shopping center owners and retailers. He began his brokerage career in 2004 and has since been recognized numerous times as one of CoStar's power brokers, signifying his place among Tucson retail brokers with the highest transaction value. Thank you, Aaron. Gary Heinfeld grew up in Tucson and received his BS in accounting from the University of Arizona. Shortly thereafter, he earned his CPA certification and real estate broker's license. He has authored several books on accounting and auditing. Gary started a CPA firm and built it to over 80 individuals. After it was ranked number 4 3 times on the 25 best small companies to work for in America and recognized by the Wells Fargo Copper Cactus Awards for best place to work in Southern Arizona, Gary decided to devote his full attention to real estate. Thank you very much for joining us, Gary. Brandon, a Tucson native with family background in commercial real estate, has been active in commercial real estate since 2004. Brandon joined the Cushman Wakefield Picor Industrial Division in 2011. Coming from CBRE, he was appointed to principal in 2015. Brandon's productivity speaks for itself, averaging 60 transactions per year, representing nearly 2.7 million square feet in commercial transactions. Thank you, Brandon. Our last speaker, Ian Stewart, began his career in 1976 and has since amassed a wealth of commercial real estate experience across the globe, having completed assignments on every continent with the exception of Africa and Antarctica.
Get working.
Get working. He moved to the San Francisco Bay Area from England in 1980, working initially as a project manager for high-rise offices before founding an advisory practice for a major brokerage in San Francisco and later Silicon Valley. Thank my panelists, please, for coming up here and participating with us today. Thank you, guys. I'd like to begin by asking each of you to provide a brief insight on any new tenants in the market, recent trends, or observations you found interesting within your respective practice. Brandon, would we start with you, please?
I would, one of the tenant, I think somebody referenced a new tenant in the market that David couldn't name, and so I won't name them either if it's the same one we're talking about, but there's a kind of a new household name that's leased. I think most people in the room know who they are. Even though I can't mention it, just turn to the person to your left or your right. They probably know who they are. It starts with a U, and it's a technology company, and they just took about 60,000 square feet out at the U of A Science and Tech Park, the former cafeteria building. And then just generally, kind of a general comment, as I was looking through some numbers, it was interesting to compare where we're at with some of the metrics to the high water mark, which I would argue is 2007, 2008-ish, and we're starting to see some numbers now. It's taken a long time to get back there, but we're starting to see some numbers that are reminiscent of 2008, and so I just found that kind of interesting. It looks like we're fighting our way back in industrial.
Thank you. Gary?
Yeah, I would like to echo that. The last we're getting back to not quite to 2008. The market's still pretty flat, but one thing that's kind of encouraging is the people to the California, they've lost 10,000 businesses in the last 8 years, and they're going to be losing more. They're going to start changing Proposition 13 to start taxing more businesses on whatever the value of that is. So there'll be more manufacturing, more businesses looking to relocate. They've been going to Nevada, Utah, Texas, and Arizona. Most of those have been going to Phoenix, so I think we need to look and see how we can attract more of those to the Tucson market.
I think in retail, something kind of a trend We're seeing a lot of retailers, a lot of action with AAA real estate, quality real estate, whether it's investors, users, chasing that. We continue to see retailers going with smaller footprints, so the dynamic, it's very fluid. Everyone's trying to figure it out. In replacement, we're seeing a lot of medical service-based businesses occupying retail centers. So it's interesting to see, and it's kind of in motion, and everyone's trying to get the pulse exactly, but that's a broad trend.
Ian?
Mining. What I fail to understand is why Tucson doesn't realize that it is a worldwide leader in mining. I don't care how you feel about Rosemont. What I see on a regular basis is there's an expertise in Tucson in mining, which people come from all around the world to take a part of. And we need to emphasize that a lot more, because I think it's an area that Tucson can excel, and we haven't done a very good job so far. Except, of course, we brought Caterpillar to town.
To expand on that a little bit, Ian, can you provide any specifics on what you hear from national tenants or out-of-state users and how they perceive Tucson?
Well, I came here 10 years ago, and at that time, I had to explain that we were not a suburb of Phoenix. That's Tempe, and Tucson was 100 miles down the road. We don't have to do that anymore. And so I do hear about the shortage of highly educated labor in our workforce. That's what I do hear from national tenants. But on an investor side, there's certainly plenty of investor interest in Tucson. You know, cap rates in California are down below 6. Good quality product in Tucson, cap rates are at 8, up or down. Our problem is we don't have enough product to sell to these people.
Cap rates are kind of going from 7, I mean, they've gone down, they're 7 to 8. We've sold some properties at 7 recently, so, but, you know, people are looking at the same thing. They're looking at, you know, a long-term tenant, you know, 10-year tenant, 7-year tenant, to really get down to that cap rate, or a single tenant.
Do you have any statistics or personal observations to discuss the successes or failure of the shared spaces concept in downtown?
It's not really germane to industrial,
Right.
but just to comment on that, we were talking earlier about downtown and how, you know, generally speaking, the taste for office space is migrating to this shared, open, you know, Google-esque type of a, you know, environment. Bring your dog to work or whatever, and you know, no hard walls. But and I think that's probably true in general. But there's still definitely some industries, let's say, that need to have kind of the traditional office space regardless of this new trend. And I know CBRE, for example, in LA went to this open new plan and they scrapped it and went back. So I mean, I think there is a caveat to that.
For all the panelists, what do you think Tucson's biggest threat to continued economic growth would be?
I guess threat, but I also see it as an opportunity, and it kind of parlays off what the downtown group was saying. I think we need to continue to focus on these large quality employers. Everyone knows that, but I mean, that has been a challenge, and I think that's an opportunity, though. And I think, I don't know if it's Fletcher who said it, but they kind of migrate and they kind of follow each other in terms of employers. And I think retailers are a lot alike. There's a herd mentality. Once you can land one that's successful, more follow. They look at each other, they look at sales, they look at different metrics, and it's the same thing I would think with employers, similar. So I think that's it's a threat, but I see it as an opportunity for Tucson.
Ian?
Well, from the work that you heard from the panel before, it's terrific that Tucson is succeeding in many areas. And we have to diversify, because right now we rely on Davis-Monthan and we rely on the university. And obviously the threat to our economy is that until we have diversified significantly, any impact to those two major employers could have drastic consequences to us here. I am delighted that Banner is building a new hospital for us on Campbell. I'm very concerned about where the medical school will be in 10 years.
Brandon, I think this would be a good question for you. In your opinion, do you think tenants are willing to pay a premium on rental rates for quality space, even though maybe there's second generation space still on the market that could be had cheaper?
Yeah, I mean, I think it really depends on the tenant profile. I mean, you know, the bread and butter of Tucson's economy is this, you know, small business, mom and pop business. Those folks are value driven. I mean, they're going to they're going to gravitate to the lowest price, regardless if it's, you know, new space, old space, what have you. The corporate, you know, users are more apt to, you know, go for quality, and so I think there's sort of a dichotomy there, and you've seen that with, you know, BE Aerospace and Sargent and, you know, Raytheon, for example. I mean, they pay what they need to pay to get space that they need, but you know, Tucson is sort of bottom heavy, if you will, with you know, the mom and pops that are just sort of the value driven tenants. So that's kind of what we see most often in our market.
We did have a property in Oro Valley, which was a spec building, which was built during the recession, and it was a shell. And actually, we have attracted, we've leased 75% of it in the last year for people looking to design their own space. And we're higher than the second and third generation space. And also in Twin Peaks, the same thing. That was a new building. We have second and third generation space in that area that might be 75%, 60% of the rent, but still people were attracted to that area. So I think it kind of depends on your location. You still can attract some of those people.
We'll go ahead and open up some questions to the audience, actually, at this point. If anybody has any questions for our brokers they'd like to ask. Instead of talking with the mic, I'll just ask you guys to speak up.
I'm Susie Young, and I have a great interest in retail. And I noticed that a lot of retailers, the brick and mortar guys, are really concerned about the online shopping. And I know that millennials don't even walk into stores anymore. What's the future for retail in this community?
That's a great point, and that's something, you know, that everyone's trying to figure out. But that's true. The online presence now is huge, and the retailers are now they're going to this omni-channel, you know, merchandising, which is, you know, have brick and mortar, but also drive online sales. So now it's mixed. You walk in and they're trying to sell you stuff, but they're also trying to get you onto their website and with loyalty programs, this and that. But the short answer is it's changing, and they're trying to figure it out. So generally, everyone's footprint the last 5 years has shrunk, and they're integrating more, you know, online presence. But I will say that there's still demand clearly for quality real estate, period. The brands want AAA real estate in good trade areas, just the basic retail fundamentals, they're there. And to touch on the question previously, we see a huge dichotomy in retail where you could have a great corner that gets, I don't know, mid-30s in rent, and a quarter mile away they're at $10. It's just such a split. And the reality is the retailers don't care. If it's a really good site, the price is almost a moot point. You know, it's all driven by sales, et cetera, but there's a pent-up demand for national and quality brands that want quality real estate. And so I think we're seeing that in Tucson, and there's a lot of opportunity. We have a lot of functionally obsolete buildings that need to be redeveloped, corners, you know, areas, but so there's opportunity there.
In regards to a shrinking square footage per employee, Ian, do you think the office sector continues to be challenged by users wanting less space?
In the Tucson market, we're challenged by the fact that we are stuck in the 70s. There's been no new construction. There is no new office buildings going on at this point, and our inventory is functionally obsolete. So we have, if you look at CoStar, 25 million square feet, 2,500 buildings. Okay, so most of them are 10,000 feet or less. That's no good. We can't attract new companies to town, large companies, if we have, you know, Class C, small 10,000-foot buildings. And probably the comment that has stuck with me most was a Phoenix developer came to town recently to assess our marketplace. And when he left, he made the comment that he felt that our town was under-demolished. And I happen to agree. I mean, if we are going to attract companies, obviously we need the concessions that Rio Nuevo and the governor is offering. We need the workforce. We have the environment. But we are struggling in providing the product. When people come to town, we just don't have the Class A product that they need. It's been worst in industrial, but it's now impacting office as well.
How close are we in each sector to getting to the level of rent and demand where it's going to make sense to do spec development?
That's a really good question, kind of the million-dollar question for any developer in the room. The numbers that I've seen require, roughly $1 a square foot triple net rents for industrial to justify spec construction, or our average is up again. We're kind of back to sort of 2008 levels in terms of pricing, but that's really at 58 cents a square foot. So we obviously don't need to average $1 a square foot to justify that, because the new product coming online would be vastly superior to the existing stuff by and large. But we probably need to be average rents in the 70s to close that gap enough to justify new construction. And how do we get there? Obviously, inflation and vacancy, and we're watching vacancy now down below 9 for the first time since 2008-9. If that continues and we get down below 8%, then all of a sudden, really the only vacancy that we have in the market is just either transitional or functionally obsolete. And at that point, the vacancy rate effectively would be even lower than that because of the inventory issue that Ian talked about. So I don't know how to answer that question, except that there's some metrics that we're watching to see. I think if we get into kind of the mid 7s in vacancy, and we watch that kind of average, rate creep up into kind of the low 70s, it's time to start really thinking about that.
I think that the economics are there, but it's just, this guy, it's just so site specific. If the right site, and a couple people have been successful the last 5 years doing, small retail spec developments. I don't think there's a huge appetite for that, what I'm seeing. But then again, you get the right piece of real estate, and a lot of people would argue you could spec build it if there's pent up demand and the right economics. But I still think we're a ways from people doing spec retail like they were in 04 to 06.
Well, on the office sector, if you want to raise rents, you've got to have vacancies of 5% or below, and we're still a long way from that. So you can get to a reduced vacancy rate in two ways. You can actually increase the leasing activity, or you can actually reduce the inventory. And I'm a little bit excited by the fact that we are reducing the inventory. Kudos to HSL, who's taking down La Placida. That takes something like 200,000 square feet of office off the marketplace. And just as Randy was commenting just now, other cities such as Detroit are converting functionally obsolete office buildings to residential. And I could see a little bit of that going on as well. And the mystifying point is, while people look at our inventory and they say, well, we have this high vacancy, the truth of it is, because it's functionally obsolete, nobody wants it. So that's somehow we've got to get past that and start regenerating our office space.
Aaron, this question's for you. When you're working with a user that's maybe coming to town for the first time, and they kind of talk about how many locations they need to properly serve the market, where's that number now with how far spread out the city has been? Are we at 5 locations that you need?
I'd say, yeah, to do, regional, kind of layup sites that will make sense all day long. I'd say there's a handful. What I see a lot of times people come into Tucson, this is one of our advantages actually for people that own real estate here, retail real estate. It's a hard market to penetrate. You go to Phoenix, you can look at the map and say, we could do 25 sites easily. In Tucson, all the time I see it, they're like, we want to do 10 to 15. They end up doing half that. It's just not that easy to get deals done, which can be a negative, but it also, for people that own, it keeps a lot of competition out in that regard. But yeah, I'd say 5 sites, is a really good kind of median number that you can serve the market. It depends on the concept, obviously, but I think that's a good ballpark.
Okay, I want to say a big thank you very, very much to our panelists to agree to come here and speak. Thank you.